Welcome to RBC's Markets in Motion podcast, recorded March 20th, 2026. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, we review our key takeaways from our review of March company commentary on the Middle East conflict on earnings calls and in conference presentations. What we read adds to our understanding of why the U.S. equity market has been fairly resilient since the Iran strikes, and also leads us to believe that it may simply take more time for the equity community to fully understand the impacts from an extended conflict. Second, other things that jump out this week include much better EPS estimate revision trends in the top 10 market cap names in the S&P 500 than the rest of the index, a point in favor of mega cap growth stocks continuing to outperform, the sharp drop in investor sentiment on our AAII model, a bullish data point for the broad market, and the return of the Russell 2000 FY2 PE to its long-term average. Important progress, but not a return to hold your nose and buy territory. If you'd like to hear more, here's another 5 minutes. We'll start with takeaway number 1. March company commentary highlights another reason for the U.S. equity market's resiliency, plus the idea that it may take more time to fully understand the impacts. It has been our experience over the years that stock pickers can sometimes be reluctant to bake in macro concerns until their companies start to openly worry about them. With this in mind, we spent some time last week reading through what companies in the Russell 3000 and S&P 1500 have been saying in March about the conflict in the Middle East on their earnings calls and in sell-side industry conference presentations around the street. In terms of the bigger picture, companies have been describing the war as fluid and evolving, with the duration of the military conflict and the closure of the Strait of Hormuz in focus. While a few companies noted the possibility that higher oil could spark a recession or an economic downturn and disruption, others emphasized that they or their customers are used to volatility or highlighted their ability to manage through. Several noted they were closely monitoring the situation and running scenarios and stress tests. One company provided some helpful framing for how to think about impact. They organized it in 4 tiers in terms of how quickly they would feel the impact: direct exposure in the region, freight shipping availability, cost and inflation including raw materials, and demand. This was a good reminder that it will likely take time for impacts to filter through. In outlook discussions, many companies noted it was early days or too soon to tell what the impacts will be. A few companies alluded to the idea that there was some conservatism in their guidance due to the conflict in part, but others expressed confidence in guidance unless there was a major escalation. Optimistic comments around manageability seem tied to the idea that the conflict will be of shorter duration. Several companies referenced the idea of passing through higher costs, having some amount of inventory on hand, one company mentioned 6 months, or the idea that impacts would not be seen until the latter part of the year. A few openly discussed hedging. Many noted that their direct exposure to the region was minimal. The outlook commentary left us thinking companies have had good reasons for staying calm, and that any risk to earnings likely lies more in second half numbers. On demand, several companies noted they had not seen material impacts yet, while a few noted their expectations for near-term headwinds. Some thought demand might get pulled forward in the short term due to second half supply chain concerns. Others noted defense-related products, things like ammo and drones or counter-drones, might be expected to see a demand boost. One company also highlighted that longer term, the rebuilding of infrastructure could boost demand. On the consumer, one company noted that the strength at the top of the K-shaped economy was a positive, as that cohort tended to be more immune to these kinds of events. On the topic of what level of gas prices would be a pain point or cause demand destruction, one company pointed to $4 a gallon, while another noted $5. Hotel travel companies noted that they had seen cancellations in the Middle East region, but it had not rippled out yet, though some acknowledged that could change in the future, especially given the sensitivity of airfares to the conflict. We've been underweight the consumer discretionary sector and market weight consumer staples this year, and what we read this past week keeps us on the sidelines for both sectors for now. We'd be more open to staples as a rebound play on conflict resolution, given better valuations. Impacts to supply chains accounted for a considerable amount of the discussion. Transportation and freight costs and the rerouting of shipments were in focus. In addition to oil and natural gas, resin, fertilizer, aluminum, and helium have been referenced. Some companies noted they would draw on past experience to manage through, and several noted no major impacts yet. Surcharges and extended lead times were mentioned. The good news here is companies have become accustomed over the past decade to managing through supply chain issues. But the bad news is this issue is clearly taking up much of the C-suite headspace at the moment, which could delay other initiatives. Zooming out, in our client conversations, we've been highlighting how improved valuations in the U.S. relative to non-U.S. developed markets generally open the door for the U.S. to act as a safe haven trade, and how our analyst survey on the war's impact supported the idea that the U.S. equity market should be seen as having some fundamental buffers. What we read in transcripts from the past 2 weeks confirms to us that companies have been providing investors with additional reasons at the company level to see the U.S. as insulated. And we think that reassurance has also contributed to the real resiliency of the U.S. equity market. But what we read last week also indicates to us that if adverse and significant impacts are indeed coming, particularly from an extended or escalated conflict, it will simply take additional time for companies to understand what those are and communicate them to investors. What we read also suggests to us that companies tend to believe a shorter duration conflict can be managed, but there are many open questions if it goes on too long. Our base case has been that the S&P 500 would experience a Tier 1 garden variety drawdown of 5 to 10% this year, which could take the index a bit below 6,300 at the lower end of that range. We have also noted that risks of a Tier 2 growth scare drawdown of 14 to 20% have risen. The 5 growth scares that the S&P 500 has experienced since the GFC have ranged in duration from 2 months to 9 months. What we read last week makes us think that if we are in the middle of a growth scare drawdown, it may not be a quick 2-month one like the tariff episode of 2025, since it may simply take some time for the equity community to fully gauge earnings impacts. Let's move on and wrap up with takeaway number 2. What else jumps out? On the rotation trade, the top 10 market cap names in the S&P 500 have seen a big surge in the rate of upward EPS estimate revisions, which is nearly back to the highs of last fall. Meanwhile, the rate of upward EPS estimate revisions has stayed weak for the rest of the index. In addition to safe haven seeking in the U.S., we think these earnings dynamics help to explain why the broadening trade has paused since the Iran conflict began and the U.S. has reclaimed leadership geographically. On investor sentiment, significant worry finally moved in this past week. As of March 19th, net bulls on the weekly AAII survey fell to minus 21.6% on the weekly data point and minus 11.3% on the 4-week average. The 4-week average is now between 1 standard deviation and 2 standard deviations below the long-term average, a level that has on average been followed by a gain of 15% in the S&P 500 on a 12-month forward basis. While sentiment got much more bearish in the last update, this is actually a positive signal for forward-looking equity market returns. That being said, a move to minus 1 standard deviation below the long-term average on that 4-week average is something that tends to be associated with milder drawdowns. In 2022, Russia-Ukraine, and 2025, Liberation Day tariffs, this indicator fell to minus 2 standard deviations on the 4-week average before things were washed out. And finally, the market cap weighted FY2 small cap PE has fallen back down to average. Along with AAII net bulls, the Russell 2000 PE is something we're keeping close watch on to help us gauge when the period of stress in equities broadly may have gone too far. Short-term technical signals rather than longer-term S&P 500 targets is what we're focused on at the moment. As of March 18th, this indicator was back down to 15.16 times, in line with its long-term average of 15.18. It had started out the year at 17.5, a bit below the November 2024 high of 18.1. We are keeping an eye out for a return to recession pricing on this indicator, which could help us tell when the current period of market angst has played out. In 2022, 2023, and 2025, this indicator fell a bit below 13 times, which is also close to where it tends to bottom out in recessions, the 11 to 13 times range. The valuation improvement that's been seen, along with a modest dial down of positioning per the CFTC data, admittedly opens the door to the possibility of small cap outperformance once Middle East clouds clear. But that may be a short-lived trade since Fed cut optimism has receded following the last Fed meeting, and we are no longer seeing better trends for small caps than large caps in some of our earnings indicators. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.